All right, so if you're looking to sell your home and buy a new one, but you're hesitant or you're waiting because of the high interest rates right now, or because you don't want to have to go contingent on a new home because you're worried it's going to take a while to sell your house, this video is for you. Today I want to talk about how you can sell your house and potentially a little quicker with what's called a 3-2-1 buy down, and how you might be able to get into that house that you really want to without having to sell your current house first. By the way, my name is Corey Quinn with eXp Realty, and if you want to know anything about the East Side Seattle market, your property in particular, or Seattle in general, in the description is my email, phone number, and calendar link, and I'd be more than happy to set up some time with you one-on-one. So first, let's talk about that option that's actually gaining a lot of popularity right now as interest rates are increasing, and that's called the 3-2-1 Buydown Mortgage. Right now, we're seeing a lot of properties on the market dropping their prices, $25,000, $50,000 to get it sold. With the 3-2-1 buy down, it's likely that you can retain that same sales price while getting a lower interest rate for your buyer. And the way it works is, first year it's 3% less. So if you start at 8%, it's 5%. The second year is 2% less. And the third year of that buyer's mortgage is 1%. So if we're looking at a $1 million home, which is actually the average sales price in some cities in Eastside Seattle right now, and we put down 20%. We got a 20% down payment, which gives us an $800,000 loan balance. So let's say on that $800,000 loan, you get an 8% interest rate, which is about the going interest rate right now with good credit. In the first year for that buyer, we would subtract 3% from that interest rate, which would give us a 5% interest rate for that first full year. So your payment on an $800,000 mortgage would be $5,629. That's literally almost $1,600 a month savings when you compare 5% to 8%. In year two, you would subtract 2% from 8%, which would give you a 6% mortgage for the second full year, and that gives you a payment of $6,130, saving you about $1,100 a month for that entire second year. And then in year three, of course, you would subtract 1% from 8%. So you have a 7% mortgage. Your payment is $6,656, almost a $550 a month savings. And then year four, you're going to start paying that 8% mortgage like you would have initially, and your payment would be around $7,204. So with this program, obviously, you can see that you're giving your buyer a significant discount and a much better deal, potentially without even having to drop the price of your home compared to all of the price decreases we're seeing right now anyways. So the main thing here is that you're offering the buyer something else when compared to all of the other houses on the market, and it just helps differentiate you and lightens the load on them a little bit. What's really cool about the 3-2-1 buy down is that when you compare it to a normal interest rate buy down, on a normal interest rate buy down, you're paying thousands of dollars to just get a lower interest rate out of the gate. However, when you spend those thousands of dollars to buy that interest rate down, that money is gone, and you can't get it back until you live in the home for X amount of years to break even. With the 3-2-1 buy down, that money initially is put into a fund, and if the buyer does refinance in that first 3 years, they can actually take that money back out of the fund that wasn't used and apply it towards the principal of the loan when they refinance. So that money can get reapplied to the principal. None of that money goes to waste like it would with a normal interest rate buy down. Next, we have the bridge loan, which helps bridge the gap from selling your home and buying a new one. What the bridge loan is actually doing is using that equity from the buyer's current house and using it as the down payment on the new house. So that means you don't have to sell your house first before you can put an offer on a new house. You're not going to have contingencies. You can make a really good, clean offer. And something that a lot of people worry about, obviously, is having to pay 2 mortgages together on your old home and your new home. But the bank will actually advance you 6 months of mortgage payments until you successfully sell that old home. So you could potentially combine both of these strategies, using the 3-2-1 buy down to attract more buyers and try to sell your current home quicker, and then not having to worry about it, but at the same time shopping around and using a bridge loan for a down payment on a new home while your current home sells. And then on top of that, when you go to make an offer on that new home that you were going to use the bridge loan for, you can ask them if they'll do a 3-2-1 buy down for you as well, so that you can get a lower interest rate for the first 3 years on that new house. So this was just meant to be a really quick video. I wanted everybody to know that these two options are out there and you can use them simultaneously, because I know a lot of people are hesitating or not buying that new home out of fear of not being able to make a good offer because you're going to have contingencies, fear of not being able to sell your current home that quick, or fear of getting locked into a high interest rate. So with all of the fears out there and this economic downturn, these are just a couple options that could really help that transition and help you make that change. feel free to reach out to me. I'm happy to talk about your individual situation and see what you qualify for. And I hope you found this video helpful in whatever part of the journey that you're on. So if you did, please like and subscribe for more real estate insights in the greater Seattle area and Eastside Seattle. And I will catch you in the next video. CQ out.